nor the current liabilities. It is usual practice to write off, it's a routine practice to write off depreciation on fixed assets which are debited to profit and loss account, and credit is made to the respective assets account. So the journal entry for the depreciation is always depreciation account debited to fixed assets account. So that's why the depreciation is debited to the profit and loss account as an expense. Still it is a non-cash items, we are debited into profit and loss account, but it will be credited to the fixed assets accounts, and that's why it will be deducted and fixed assets has been decreased. So according to this transaction, the net profit has been reduced but not the funds. That's why the net profit is reduced but not the fund has been reduced. This is a purely non-cash, non-fund transactions, therefore it should be added back to the profit, and that is why it not affect to the fund flow statements. We need to prepare the adjusted profit and loss account, and in adjusted profit and loss account it should be added back to the profit. It is added back to the profits. Moving to the next point, that is amortization of fictitious and intangible assets. This is also works same way like a depreciation. Amortization and the write-off of fictitious assets, it is also a part of the non-cash items. Like any transactions regarding the intangible assets write-off, like goodwill, patents, copyright, trademark, or fictitious assets like preliminary expenses, advertisement expenses, underwriting commissions, discounts on securities, such items are write-off. At that point of time, it decreases the value of assets, but it's never affected to the fund. Definitely, whenever you write off these intangible assets or fictitious assets, these assets are going to reduce. Definitely it's reduced, but this reduce effect would be recorded in the profit and loss account debit side, but it never affected to the fund. It is never affected to the fund, and that's why if it is not affected to the fund, again it is to be recorded in adjusted profit and loss account and added back to the profit. It would be treated the same way like a depreciation. Moving to the next point, that is profit or loss on sale of assets and investments. Now this is very important transaction because of the profit or loss on sale of investments affected twice in financial statements. How? I'll show you. When the fixed assets and investments are sold during the year, the sale proceeds will be shown as a sources of funds. Because of you sell out the property, you raise the cash in the business, and that is why it shows as a sources of funds. But if the profit on sale appears twice as a source of funds, then it occurs once in the sale proceeds and the other that time in the net profit. Take an example. 5,000 rupees 5,000 of fixed assets sold at the rate of rupees 7,000 in the market. Now what would be the concern? The value of assets is 5,000, sale out at rupees 7,000. It means the difference is rupees 2,000. That is your profit. Now what would be the journal entry? Cash comes in, cash account debit. How much cash comes in? 7,000. How much property has been sold out? What's the cost value of the property? That is 5,000. So fixed assets account 5,000. And how much difference is that? That is 2,000. So P&L account credited because of the profit, 2,000 rupees profit credited. Now see how it would be recorded twice. One, the how much amount of cash realization? 7,000, which includes 2,000 rupees. So cash increase 7,000, which affects net working capital. It increased. So including 2,000 rupees, it's recorded the cash. And what would be the another effect? The profit which you are showing in the profit and loss account credit side of rupees 2,000. It means the transaction is one, profit is one, but it affects financial statement twice. It means there should be one effect is reversed. And for that, the one effect must be reversed to know right inflow of funds. That is, on selling the assets, the profit will be shown as a credit item of adjusted profit and loss account. And if the loss is incurred, then it would be a reverse debit item of the adjusted profit and loss account. It means Which item would be reverse? This item would be reverse. If the profit was recorded in the credit side, it should be deducted from the adjusted profit and loss account. So the profit must be deducted from the concern. But suppose in case of a loss of the sale of fixed assets and investment, then the loss would be added back into the profit and loss account. So this is all about the third item, profit or loss on sale of investments. Let's move to the next point, that is the provision for taxation. The provision for taxation can be recorded by two methods. Why it is actually considered by the two methods? Because of there are certain principles for that. Let's how it would be considered. I'll tell you. Provision for taxation can be recorded in working capital statements as a current liability. So if you are recording provision for taxation as a current liability, then it would be considered in the working capital statement. But it can be recorded in other way also. Prepare separate account of provision for taxation and directly recorded in the fund flow statement or in adjusted profit and loss account. So there would be two possibilities. One, you can consider as a working capital statement as a current liability, and either you may be prepared a separate account and recorded two effects of fund flow statement and profit and loss account. Now see that in case, now there are certain principal and main features I'll tell you. In case if there would be no adjustments regarding provision for taxation in the current year, then you treat provision for taxation as a current liability and write down in the working capital statement. It means if there are no changes during the year regarding the provision for taxation, consider as a current liability and write down in the working capital statement. But suppose if there is any adjustments regarding the provision for taxation, then treat and prepare a separate account of adjusted profit and loss account and treat as these entries. One is recorded in the fund flow statements as the tax paid, and the another is a provision for tax during the year recorded in adjusted profit and loss account. So this is an entry for the provision for taxation. Moving to the next point, that is provision for reserve. Provision for reserve also do not affect the fund because it is just an adjustment internally. Transfer your profit to reserve. It means the cash is not goes out. Overall fund has not been changed, and that's why it would not be considered in the part of fund flow, and that is why it would be added back into the adjusted profit and loss account and write down on the debit side. Dividend, which is the last item of the adjustments. If the company pays any interim dividend during the year, it will have two effects. Any dividend paid during the year, that is interim dividend, they have two effects. One, it will be recorded in adjusted profit and loss account debit side as an interim dividend paid. The another effect is in the fund flow statements, the fund goes out paid interim dividend. And in case of any proposed dividend is given in the balance sheet, it would be recorded the last year proposed dividend considered as a paid dividend in the fund flow statement as an application of fund, and the current year provision of proposed dividend treated as a provision of proposed dividend for the current year in adjusted profit and loss account debit side. This is all about the adjustments of a profit and loss account. So here we are going to concern what are the effects of the adjustments regarding the profit and loss adjustments. Now moving to the next point, that is adjusted profit and loss account, determinations of the fund from operations. As we already discussed in the previous part, that is the adjustments regarding the non-cash items which are affected to the fund flow and affected to the operations of fund. The same thing which we are going to reflect here, and we will see the pro forma of adjusted profit and loss accounts. Here the adjusted profit and loss account is prepared so as to find out operating profit of the business from cash inflow and cash outflow in real. So this account shows non-cash and non-business expenses as the debit items And on the credit side, it shows non-business incomes. The closing balance of the profit and loss account of the previous year would be showing on the credit side as an opening balance, and the closing balance of the profit and loss account of the current year, it shows as an opening, as a debit item on the adjusted profit and loss account. So here we are going to see the pro forma of adjusted profit and loss account. See, in the adjusted profit and loss account, which items are going to record on the debit side and on the credit side. Let's begin with the first item, as I already discussed, by balance brought down, which was the balance brought down, which is recorded. It's an opening balance of profit and loss account. Opening balance of the profit and loss account, it means the last year balance. It is recorded here. And the closing balance of the profit and loss account, or we can say the current year balance, that will be recorded at the last item in adjusted profit and loss account debit side. Now we will see the other items which are going to record here. First is to depreciation, then amortization, then write-off intangible assets and preliminary expenses, then the any amount of provision for taxation, then provision or proposed dividend. These are the items which are going to record it here. Then the loss of sale on sale of fixed assets and investments. So whatever the amount has been determined from the sale of fixed assets and investments, in the case of that loss is arise, would be added back into the profit. Any further provisions for general reserve or debenture sinking fund or any other provisions are going to need it, which is also recorded in adjusted profit and loss account debit side. To premium on redeemable preference shares is also going to record here on the debit side. So these are the items would be recorded in adjusted profit and loss account debit side and added back into the profit, so that we would be identified the current inflow and outflow of the fund from the business operations. Now, which are the items to be recorded on the credit side? One is the profit on sale of fixed assets and investments is going to record on this sides. So any amount of the concern would be recorded on the credit side, and the difference of this two would be the answer of adjusted profit. That adjusted profit is concerned that the operational profit of the net inflow of the adjusted P&L account. So this is all about the part of the adjusted profit and loss account. Now here we are moving for the last step, that is the differences of a fund flow statement and balance sheet. Here the fund flow statement and balance sheet, the main important difference is what? The statement shows the changes of financial statement between the two dates. That is fund flow statement. Where the balance sheet is the statement shows the actual positions of the business on a particular date. This is the main difference between both the statements. One, the comparisons of the two consecutive years data. The another is actually a data has been displayed at the particular date on the same year. It reveals the flow of funds during the period of time, where the balance sheet is actually reflects the assets, liabilities and other capital informations on a particular date. It is a managerial tool which actually helpful to analysis of financial statement for further decision making, and this is a sources of informations regarding the financial positions of the business which would be helpful to get a basic informations for the future part of decisions and identify the soundness and the wealthness of the business. Here the fund flow statement has been prepared from the 2 consecutive years balance sheet informations, where this statement is prepared on the basis of a trial balance and the other additional informations. Here it is deal with accounting effects of a working capital, and this is a deal with a personal and real accounts. So this is all about a part of a fund flow statements and the balance sheet. Moving to the next adjustments, that is fund flow statement and profit and loss account. Ultimately, the fund flow statement is very simple. It's just a comparative analytical statement prepared as per the law or as per the guideline. Here the statement which is actually necessary to prepare to understand and evaluate the profitability of the business during the year, and this is compulsory as per the law. Both capital and revenue items are considered at the time of preparing the fund flow statements, but in the P&L account it's only considered of the profit and loss account. So only revenue items would be considered for the preparation of P&L account. Revenue statements helps for the preparation of fund flow statement, where the statement cannot be prepared from the fund flow statements. Here the informations are regarding the revenue accounts would be recorded in the P&L account, and the P&L account is prepared. It shows a financial positions and the movements of flow of funds during the year, and this shows it reflects the changes of financial positions of the business. In short, all about the financial differences of fund flow statement and the profit and loss account. It comes here.